Michael Ward of Seaport Global giving Lyft its first sell rating with a $42 price target. He joins us over the phone. Great to have you with us, Michael. Appreciate your patience. Let's just begin with the difficulty of valuing this company. Why people find it so difficult?
Thanks, Joe. Good morning. It is very difficult to value it. It's a different animal. It's a company that does not make money, and there's really no prospect to make money over the next 4 to 5 years. I think the positive side, they've had tremendous revenue growth. So really, to value it, you got to come up, well, what is the revenue potential? And that's where I came up with a sell rating.
So, Michael, I want to talk to you about something else as well, perhaps where people are overestimating how big this industry can be. One point you've really underlined is the optics of vehicles being an underutilized asset. You share that view, just not to the degree others do.
Exactly. Well, there's no question that vehicles are underutilized, but they're also very convenient. You know, you have a car sitting in your garage, but you're able to take, quite frankly, houses are underutilized. You know, how much space in our house do we use? But that doesn't mean you're not going to live in a house or you're going to rent a house or only rent a room or a hotel room for that matter. I think when I look at the transportation as a service market, I do think it's got a very bright future because, let's face it, Lyft, Uber, these ride-sharing services are awfully convenient. But as far as them substituting for car ownership, I think that's remote. And I think you really have to take a leap of faith to think that future generations are going to forego home ownership, or I'm sorry, car ownership or vehicle ownership to rely solely on ride sharing and the lack of convenience that provides.
So, Michael, let's talk about where we're pricing now. We're at around $70. You're looking for much more downside from here. What is it that the market still doesn't quite get in your view?
Well, I think clearly as a new IPO, it's going to be volatile. And over the next couple of weeks, you're going to have 25 brokerage firms with a positive bias. They supported the stock at 72. I would expect them to have a positive bias if it's trading below that price. I think when I look at it, over the next 6 to 12 months, there are several things that can come to reality. First of all, autonomous driving. The prospect of level 5 autonomous driving is remote, decades out in the future. And so that takes away one of the big bull points. And then again, when you look at some of the data from millennials, and if you new licensed drivers, increase in licensed drivers in the U.S. in the last 3 years was the highest in 40 years. Home ownership by the under 35 group, the millennials, up 8 consecutive quarters year over year. So you're starting to see that millennials are following a similar lifestyle pattern that previous generations have followed. And I think over the next 6 to 12 months, that will be reflected in the valuation of Lyft. Listen, we're still putting a big valuation on the company. 3 times 2020 revenue is a big number.
Michael, and just to wrap up, I think on the issue of autonomous driving, this is somewhere I struggle too. Let's just say this is going to be big and it happens sooner. I struggle to understand why Lyft is so well positioned to take advantage of it, given the likes of Google, say, with much deeper pockets, could be better positioned to execute.
There are dozens of companies that are better positioned than Lyft to take advantage of autonomous driving. They would say, right now, the technology to make a car fully autonomous is about $150,000, and including the cost of the car. Lyft doesn't own any cars. So now suddenly they're going to go out and start buying, a whole fleet of $150,000, $200,000 cars. They're not in the position to do that.